Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 16th, 2020. We see our disclaimer for important information. Here is our weekly COVID tracker that you can see the continued rise in that blue line, which is the 7-day moving average for new positive coronavirus cases, and that continues a trend that began at the beginning of September. As you can see on the bottom, the amber line, that number continues to come up a little bit at a lag from when we saw the rise in the blue line, but that's our 7-day moving average of daily deaths. And as you can see, the important takeaway in this, even though we have a dramatic rise in case volume, that the daily death rate continues to fall. Here's a look at that same rise in positive cases, but on a regional basis. And you can see the real hot spot right now, or hot region, if you will, is the Midwest. That we've seen a rise in just about every location, but the biggest problem area is in the Midwest that goes from the Dakotas, frankly, all the way down to Texas. Here's a quick look at the case volume of the U.S. Relative to really Europe, and we know that we've seen that rise, a dramatic rise in Europe, and those areas continue to go up in tandem with the U.S. We've seen a fairly dramatic rise across the world, frankly, and in particular some of the areas not represented here, like emerging markets and India, have witnessed pronounced rises as well. Case fatality rate, this is basically taking current weekly deaths divided by positive cases at a 2-week lag. We've shown this before. The good news is, and you could read through this on the first slide that we showed you, is that, with the rise in cases, even though there's a rise in daily deaths, it's disproportionate. And so the case fatality rate continues to slide down a little bit. And that's obviously positive from a fatality rate standpoint. Here is our high frequency data chart that we get from First Trust every week, and you can see again the continued noise in the data. The good news is, at least over the last week, we saw a kind of a reversal of sorts in TSA checkpoint data and gasoline sales. Hotel occupancy continues to be weak. We probably will expect to see that weakness, particularly year over year, much more pronounced during the holiday season, to the extent that we have this problem with coronavirus cases continuing to rise during the holiday season. But steel production, rail car traffic, slightly positive. That's a multi-week trend. That's good news. Box office receipts, we've talked about that before. And then staffing and jobless claims. Actually, we've seen, after a little bit of a lull in labor around August, September, we've seen a little bit of an uptick and better employment data, continued drop in the unemployment rate, very positive, but there's still a lot of looming change coming at the end of the year with a lot of stress coming from the benefits that are being paid to workers expiring and other things that are afoot that could cause some stress with workers and employment at the end of the year. I got a couple of charts related to consumer spending, which, as we know, is 2/3 to 70% of the economy. And this is just a quick look from JP Morgan of consumer card spending relative to a year ago. And so where we are now, we've seen a little bit of a rolling over. We were almost to that break-even point in the early part of this month, or excuse me, the early part of last month. But we're right now somewhere about 5 to 6% below where we were a year ago. And we know that most of those are on the goods sector. Goods spending is up, services spending is down. And that's a continuation of a trend that I think we would expect to see for some time. This is something I found out of Civic Science, which I thought was really important. And again, we're trying to get these read-throughs for holiday spending, which for a lot of retailers accounts for a really outsized proportion of their annual sales. And here it says that 30% of the survey respondents, and again, this is 4,000 respondents in the month of October, that said that giving gifts in the holiday season amidst the pandemic was less important to them. And so, to the extent that, again, it goes to what consumers do, not necessarily what they say, but the sentiment is perhaps a little bit weaker this year than it has been in years past with regard to the intentions of holiday spending. This is a figure that we got from, or chart rather, that we got from Standard & Poor's, and it's a forecast, again, of these holiday retail sales. And as we're looking into, what that looks like, I mean, there's a median forecast that said that, we're going to have perhaps a slightly positive, and this is probably more of a factor of, or applying an inflation factor to the year ago number, as opposed to having, a really strong surge in aggregate spending. So the bottom line here is that the baseline forecast is for a fairly muted retail sales number. And as I've shown in weeks past, and showing different data from different data sources, that right now the estimates are still kind of all over the map right now, and we've got some that are much more optimistic than others, and this one's kind of meh, not very conducive. But I think there's a real risk that we need to pay attention to as we get, not only next week, which is on the eve of Thanksgiving, but certainly Black Friday, et cetera, and what that looks like for the implications for year-end sales. Here's small business optimism, which seems to want to jockey around a little bit. Now this is from the National Federation of Independent Business. There are puts and takes. There's stress in small business. I've talked a lot about that in charts, and I've shown you a lot of charts to kind of illustrate the stress in small business. Optimism, I think, is flagging a little bit, but it's obviously higher than it has been. But just one indicator of what we see in the small business sector. And this is something that dovetails with that. So while you might have an optimism, small business optimism number from the NFIB that maybe doesn't look so bad, you have an increase in business uncertainty. And there's, the longer this pandemic goes on without assistance specifically designed to help support small businesses, you're going to continue to see, high readings here in this uncertainty index. This is another small business indicator from Goldman Sachs, actually, which says, it's surveying small businesses to say, do you think your business will survive? And it looks at it on a trend line basis. And, I think back in April, there was a lot of uncertainty, but the answer was yes. And the no answer was 4% of the total. And then you had some uncertainties. And as you can see, maybe May, when we had a little bit of a rolling over in case volume from that first wave. July was kind of that second wave. And then those numbers were a little bit lower, but consistently September into October, we've seen more uncertainty and perhaps a slight uptick in kind of the more despondent, if you will, business owners that are answering or responding to the survey. Economic surprise index. So we are seeing economic surprises kind of tailing off. Now this is kind of a diffusion index. So what it's telling you is that the preponderance of data is still better than expected, but those beats are getting less pronounced and less poignant. And I think you're going to maybe continue to see this trickle down a little bit until we get fiscal stimulus that's going to help these numbers and give us better clarity, for this long-term improvement in economic conditions, which frankly I do see, but the lack of stimulus in helping small business, which accounts for a large part of the economy, it is going to provide an anchor to that growth and basically delay the benefits that we'll eventually see in the economy a little bit longer, especially the longer that this pandemic goes without a vaccine, a broadly distributed vaccine response. Here's our quick view of inflation as defined by the Consumer Price Index. We had seen some inflationary or re-inflationary pressures following the dip earlier this year. That's beginning to roll over a little bit. Again, nothing to alarm ourselves with. I mean, because frankly, the survey was for 1.3% year-over-year inflation, which not only is well below the Fed's 2% target, but it's actually fairly benign overall. So I think the bottom line is we're going to be staring at low interest rates, short-term interest rates for a long time. The whole idea that the Fed put out back in August at the Jackson Hole Summit was that they're going to let rates stay at zero for longer so that over a trend line basis, which is perhaps a few years, that inflation would spike above 2%. But right now there's clearly no supporting impetus to get to that 2% barrier, and probably not going to be that way for some time. Core CPI inflation. This is kind of looking at this in an X-ray form, and so it's interesting to always look at the components of what that is, and what you can take away from this chart, even though this is a little bit noisy. There's a lot of components that go into calculating the Consumer Price Index, but rents and owner equivalent rents. Basically, the cost of housing is positive, where we've seen other things like apparel and Medicare services and things like that, healthcare, and then motor vehicle insurance, and these components take away from the inflationary impact of rents and owner equivalent rent, which we know that housing has been very strong both on the rent and the buy side, and that's probably going to continue for some time. So I'd expect that black component here on this chart related to that housing component to remain a tailwind behind inflation, but that it will be offset by several other things that will continue to be impacted, like lodging, by the pandemic, not only near term, but also probably long term. And it'll take things like lodging, and air travel and things like that, probably a good 1 to 2 years after the pandemic is over to kind of fully recover. I wanted to show a quick chart on China, and this really caught my attention. And so much has been made over, the tariffs and the trade war and whatnot. And you can see the effective tariff rate here during, these last several years, basically, during the Trump administration, really kind of take off in relative terms. But oddly enough, in 2020, and this probably has as much to do with the fact that we've seen a contraction in global trade as it has maybe particular momentum from China. But for all the hot air and the rhetoric over increased tariffs, China's exports as a percent of global exports is actually up by a full percentage point here in 2020. There's a lot of speculation over how we're going to approach China under a Biden administration. I don't think it'll be particularly warm, especially not at first, but that there's still some bipartisan animosity towards China. But again, just showing this to you is just interesting that China's share of global trade continues to increase despite what the U.S. is doing. This is some data from S&P that we got from First Trust, and I think it's interesting to show, and there's a lot of data on this page, but it just basically shows you the total return for each of the perhaps the last 12 years, and it gives you a year-to-date return through the end of October, but it shows you the number of down months, and this is just kind of a highlight to the fact that in most years we have a lot of volatility, a lot more volatility in the market. And it's odd that in 2017 we had no down months. And we had a total return that year of almost 22%. But you can see in the years that we have, 6 to 8, down months, you tend to see lower returns, just like in 2015, 2011, and obviously 2008. We had a fairly large negative event there, but we had many down months that year. And that in years where you tend to have less, you tend to have really, really good returns. And so the average number of down months is actually below 6 in this case. So, which kind of goes to the theory that you tend to have up years, and that's why you tend to have an up market over longer periods of time, to the tune of, somewhere between 5 and 10%, depending on your time period. But so far in 2020, through 10 months, half of those have been down. And as you might expect, our total returns for the year are kind of muted. So again, we don't know what's going to happen for the balance of November and certainly for December. But I thought that this was illustrative to kind of suggest that, if you have more down months in a particular year, that you should set your expectations bar accordingly. This is the MSCI ACQUI index. And what does that mean? That is just basically the index for global stocks. And this just goes to show you that the U.S. is not the only market in the world that is witnessing an updraft here. Global stocks are at obviously a multi-year high. They're doing fairly well. As indicated by this index, even though here in 2020 we've had a fair amount of volatility in international stocks as well. This is a quick check-in on fund flows from EPFR Global. You can see that we've had net outflows for much of this year, and certainly during the peak pandemic period, I guess during phase 1, if you will, and still into the summer. But the data has been a little bit different lately, and we saw a huge spike here in just the last couple of weeks on fund flows back into equities. A definite risk-on trade. And accordingly, you can see the S&P index right here as you're tracking through multiple years. We're kind of bumping up against this long-term trend line that kind of dates just following the last bear market and recession. You can see us pushing through 35 to nearly 3,600, and that's bumping up against the upper boundary of that long-term trend line. And consequently, you would expect increasing participation, which is good. We didn't have that earlier this year. We had, strong influence on the overall index by just a handful of stocks, and now you've got a fairly high percentage of the S&P 500 members that are above their 200-day moving average. So this is a reflection of what we would hope, or what we would characterize as kind of a much more healthy market, that you've got more than half of the stocks in the index that are moving in the same direction, that are moving at the same pace here. In fact, that number, almost 85%, it's as high, almost as high as it's been in well, certainly since the end of last year. But if you look over a multi-year horizon, it's as high as it's been in many years. Interestingly enough, as much as we talked about the FANG stocks and technology earlier this year, this is just a trend series that just goes back to November 10th. So it's just essentially looking at the last couple of days. So in some of this updraft that we've seen, it's interesting that the old value stocks, if you will. The industrial stocks are outperforming the NASDAQ stocks, and we've seen a little bit of a reversal, which might portend a change in trend from growth to value. Just not real sure, where this takes us right now. But I thought this was really interesting, even though it only kind of characterizes, a very short period of time. With the rise in equities this year, and without a corresponding increase in earnings. Obviously, we've been challenged on earnings this year. I think we'll see in a second that that there is expectation that earnings are going to recover next year. But right now, as they're fairly as earnings growth is challenged, the earnings yield, which is essentially the earnings on companies divided by their stock price, is at a long-time low. We haven't seen this in a very long time, and it just goes to show you that that we've seen such tremendous upheaval in our market, and even on the upside, in some cases it might be an indicator that stocks are ahead of themselves, but at the same time we know that earnings are a bit depressed because of the pandemic related issues. This is a chart that kind of actually plots that earnings yield against the 10-year Treasury. And so what's interesting about this is that even with this trend in earnings yield, that rates are so low that the difference between the S&P 500 earnings yield and the 10-year Treasury yield is at a low that we haven't seen for many months. And the latest gap here on this, which was on November 10th, was about 2.7 percentage points, which is actually very interesting. So with this updraft in the market, it's been very interesting to watch the trends in earnings yield and this particular comparison, because this is kind of a relative indicator of the attractiveness of bond yields versus stocks. Now, earnings yield is not dividends. It's just simply the earnings per share divided by the price. And so we'll obviously continue to watch this, but interesting to see it as low as it has been here lately. And this is what I was alluding to a couple slides ago, that again, this is LPL research, but it's taken from data that comes from FactSet, which is a database of earnings estimates from Wall Street firms that follow the S&P 500 companies. And at one point, I actually contributed to these FactSet numbers. But anyway, you can see that fourth quarter is going to be negative. This is contributed heavily to the negative earnings have contributed heavily to what I've described to you earlier, as that earnings yield falling. So you're getting prices going up and earnings are actually going down. So it's making that number look even worse. And but next year, again, if you have to have faith in at least some type of a pandemic vaccine response that is kicks in and helps to support economic growth in the second quarter. And here it's showing a fairly strong rise in earnings in the second quarter, and then having that follow on through the end of the year. Now, if you see this, I think there's a strong tailwind of support into equities, because you're going to get a rebound in equities, and that's going to help to push values higher without stretching earnings multiples. But this is the number to watch. And fourth quarter we know is going to be down. First quarter we expect to be positive, but the question is it going to be 10-15%, or is it going to be more like 5%? And can't say that at this point in time, but at least what the analysts are projecting are a fairly strong first half response. I would expect that they would as we get into the next month, especially with the rise in coronavirus cases and some of these, areas that are kind of going to essential travel and only, and some of these other restrictions that, analysts will bring their estimates down, but needless to say, they're still going to be positive next year. We've talked a little bit about value versus growth, and value over a long period of time, decades, tends to outperform growth. Now, that has clearly not been the case for some time, and it certainly has not been the case this year. And looking at the market over the last probably the month or so, we've kind of had a change in leadership. So we don't see the technology stocks, which are more growth oriented, lead the way as much as they did. In fact, they've retrenched and they've actually kind of ceded market leadership to some of these more kind of staid industrial stocks, this under the premise that we're going to have a vaccine, and Pfizer's news and Moderna has gotten people somewhat excited over our prospects for economic recovery next year. And so, that's given a little bit of support to value stocks. But you can see here in this chart from Scotiabank, which is derived off Bloomberg data, that the growth index has just been a real horse. And if you believe that there is a rotation in the offing, if you believe that a vaccine will be widely disseminated and second half of next year will be in a bit more of a steady state economic growth, then I think that would argue for some of these value stocks, because they're clearly at a price to earnings ratio or a valuation multiple that is a mere fraction of what the growth stocks are trading at right now. And as you might expect, with Pfizer's announcement and kind of this renewed enthusiasm, perhaps, post-election, at least we know, we feel like we know who the president's going to be, even though we've got some things to kind of sort out here. But, clearly the Pfizer's announcement, it prompted a real surge in bullishness on the part of individual investors. And this is the AAII, which is the American Association of Individual Investors data. This is their index. And so people are really bullish right now. They're throwing money into the market. They're throwing caution into the wind. You've seen a real disinterest in risk protection, i.e. Treasury bonds, and you've seen a lot more interest in equities here lately. And I think that the one thing in this that I want to point out, given the fact that we have more individual investment in the market than we did in many years past. I mean, we've got Robinhood, we've got all these platforms that people are throwing a few nickels here and there. You've got more individuals in the market, and this index tells you that we've had this wholesale shift in bullishness, really spiking above 50 in a really short period of time, and that's a serious betting on the come right here, and that's saying, all right, we are gung ho, we got a vaccine, let's plow ahead, and I think we're going to see, I just want to put some caution out there that says that, we're going to have bumps in the road. We got to get through a phase 3 clinical trial of this Pfizer therapy, this RNA therapy, and we've got to see, much more data before people can really get excited about the prognosis for an efficacious vaccine, and obviously excited about its ability to us to have enough doses to inoculate everybody. But short term, we got a lot of bullishness. That could kind of pull back to this longer term trend. Don't know yet, but again, it'll have a lot to do with what we see in the data over the next couple of months. Consumer spending, holiday spending, jobs, in the real estate market. We've got a lot of things that are going to happen at the end of the year, these forbearances and moratoriums on evictions all of these things are going to expire. So the world as we know it is clearly going to be evolving over the coming 60 days. So our 2 to 10-year government bond spread, we see that bond spreads are widening out again. And, this is just essentially the difference in yield between the 2-year Treasury and the 10-year Treasury. Having this widening spread is really good for the financial firms and gives them a little bit more financial flexibility and allows them to do more aggressive lending because their balance sheets are better supported. I think it's net a good thing. This also factors in a little bit of inflation expectation on the longer end of the curve. Not sure if it's well founded at this point, but at least it's being kind of built in. And it also has something to do with treasuries being, as I mentioned in the last slide, a bit more unloved right now. So, with increased supply, prices are down and yields are up correspondingly. And so this number is perhaps a little bit higher than it otherwise would be, but nevertheless, it's good to see a non-flat yield curve. And a sentiment indicator here, and this is from Oxford Economics, and it's a global survey, and it just says, from the difference between September and October, are you more negative about global growth prospects? And this is looking at over 2 years. And, what's interesting is even though we've had this updraft, if you will, in the equity markets, these indicators kind of suggest that, people are a little bit more cautious, a little bit more guarded in their optimism with regard to growth over the next couple of years. Again, this is just looking at it from 1 month to the next, and so I wouldn't draw a lot of hard and fast trend conclusions to it, but it's interesting to see that amidst this equity market action that we have this survey that shows a little bit less enthusiasm as far as longer term expectations. This has a lot of noise to it, but I wanted to show this because gold has been a real horse this year. It's been a real positive influence on the market, and this is as much for educational purposes as for anything else. And this just shows you a correlation between gold and the stock market. And what you've always been told, and it's valid, and this proves this out in this chart, that gold is a good hedge against the equity market. And what this shows you is that the gold has been, has had at best weak correlation to equities. That means that like ups and downs are not as correlated between those two. Weak positive to just flat out negative correlation, which means when equities are up, gold's down, and vice versa. So what this shows you, going back to 2016, is that gold is a really, really good hedge for the S&P 500, even if lately in the last couple of months that we've seen an increased correlation between gold and stocks, meaning that gold and stocks have kind of moved a little bit more in lockstep, but not really strongly. So anyway, I thought this was really intuitive and helpful in our financial planning discussions with our clients to show that gold is an effective hedge for equities. And to conclude today, I've got a couple of things that kind of talk about, this one in particular kind of talks about, well, if you're not commuting, what are you doing? And I've always been kind of intrigued at, the data on this, but, a lot of people are working. They're getting more done. They're working on their primary job. They're also working on a second job. And we know that from business formation data that a lot of people that have been stuck at home are actually working second jobs now too. And we've seen home improvement, outdoor leisure, everything that you see here. Just kind of interesting that people are getting more done staying at home. And this is, I think there's a lot of evidence that's going to support that, the office market and whatnot, that people are going to continue to be in the office, but the ones who don't are going to have time for a lot of other things. Then I'd like to conclude with this whole trend, and this may have some well, it does have some some tangents into the economy, but it just shows you in all of these different continents and geographies that you've had a strong trend in rural to urban movement and in the population. And in some cases, it's been like in Latin America, it's been really pronounced over the last 70 years. But it's clearly a trend that's taken hold everywhere, not just in China, not just in Asia, but all over the world. We see increased concentration of population centers. So just thought that was interesting to pass along. We'll do it for charts of the week for this week. Hope you've enjoyed that. Feel free to reach out to me if you have any questions and comments. I would love to hear from you. Have a safe week, have a good week, and we'll talk to you again soon.